time. Otherwise, we wouldn't need protective stops. Otherwise, we wouldn't need things to protect us just in case we're wrong. But as long as we're right more often than we're wrong, and as long as when we're wrong small, but when we're right bigger than we are wrong, then we stay in this game forever. All right? Now, the tools that we need for this tactic are three simple tools. We need a candlestick chart. All right? I believe that reading the moves of the market are easier visually using the candlestick form. It's just my opinion, but that's what I've been using for many years. We need a 20-period simple moving average, all right? As I mentioned yesterday, I have found no evidence in my almost 28 years of trading the markets and using the moving averages. I have found no evidence that the other versions are superior, but if you're stuck on the other versions, if you're in love with the exponential or whatever, it still can be used. The difference is not that much because I use the moving average in a very general way. So whether it's off a few ticks or not, the difference between exponential and 20 is just not large enough to really make a huge difference, in my opinion. But if you have no preference, I encourage that you opt for the simple version of the 20-period moving average. Now, we also want Bollinger Bands. Now, Bollinger Bands can be set at any. Bollinger Bands can be set at any. There's a popular Bollinger Band with a 14 periods versus the 20. I like the 20-period Bollinger Band with 2 standard deviations, and this is a very common thing. Almost every platform that allows you to employ Bollinger Bands will have 2 spaces for you to, I guess, opt for. I'm assuming your program is the same, where you can set it for 20 periods and 2 standard deviations. Okay, but that's the setting that I recommend for the Bollinger Bands. Now, so you need simply a candlestick chart. All right, my candlestick charting program shows the down bars where the bars close below the opening price. That is a red bar. When the bar closes above the opening price, it's a green bar. Your program may be black and white or a different color. The colors don't mean anything. All right, but that's how my program presents it. We need a 20-period simple moving average on your chart, and you pick your time frame, guys. What I'm about, I like to instruct on the daily, because when I use the daily for instruction purposes, the daily time frame has extraordinarily clear patterns with less noise. So I always teach the concept using the daily time frame, but everything I teach is applicable to any time frame. Human nature is what creates these patterns, and human nature does not change when you move time frames. So if human beings are trading the market on a daily time frame, they're not going to suddenly become emotionally and psychologically different human beings because you now have a 1-minute chart or a 5-minute chart or a 15-minute chart. So because we play human interaction and identify patterns based on this human interaction, it's the same in all time frames. So you pick your time frame, whatever time frame you like to trade off of, this can be applied to. If you like the 5-minute, okay, the 5-minute candlestick chart is your time frame. If you like the 1-minute, the 1-minute candlestick. If you like the 15-minute or the daily or whatever, or you like a variety of them, that's fine. That's the way we trade. All right, we trade from the 1-minute to the 5-minute to the 15-minute to the hourly, and we look at each window as a separate group of opportunities that can present themselves. Okay, and then of course we need the Bollinger Band, which I've just superimposed on the chart here. 20-period Bollinger Band with 2 standard deviations. All right, so those are the 3 tools we need. Very simple. Okay, guys, I know there are a lot of traders that use a huge amount of indicators. And if that works for them, I am no one to argue with results. Whatever gets you your results, you should obviously continue to do it. What I find is that traders oftentimes go too far in the direction of indicators. And these indicators start to conflict and fight with each other, further adding complexity and confusion for the trader. And then what begins to set in is a paralysis of analysis. The trader gets paralyzed because this indicator says that and this one says that or whatever, and this game is far more, it's difficult enough without us adding extra layers of complexity. So I often find that I often have to have traders step back from indicators and go back to simple price reading with 1 or 2 indicators, all right, and not 10 or 15 or 8 or whatever the case is. Right, so you'll never find me really teaching a lot of different indicators, but if that works for you, that's fine. But here's the strategy, guys. I'm going to explain the strategy in detail to you. The first thing for the market fade tactic we need to do is we need to wait for an entire candlestick bar to form outside of wide Bollinger Bands. Almost every word in this statement is important. We need the entire, that's the first word that's important. Now, I'm willing to flex this a little bit, but the vast majority of the bar I want completely outside the bands, okay? Those bands must be wide at the time it reaches outside of the bands. What we're not interested in is a candlestick bar that is outside of the bands, outside of the upper band or outside of the lower band, but the bands are narrow at the time it gets outside of it. That is not what we want. We want the bands to be wide at the time that the bar appears or forms outside of the upper or lower band. So that's important. The entire bar or almost the entire bar outside of wide Bollinger Bands. That's criteria 1. Then we want to buy if it's outside of the lower band, we're looking to buy. If that bar forms outside of the upper band, we're looking to sell. Short. Now, we're going to buy or short once 25% of the outside bar has been retraced. So we're not looking to just blindly buy or short the bar outside of the extreme bands. We need some retracement of that outside bar to occur. And the amount I've chosen is 25%. We need a quarter of that outside bar to be reversed. So as an example, if a green bar is outside of the upper Bollinger Band, we need the next bar to come down and retrace 25% or more of that green bar that's outside the Bollinger Band. Or we need the same bar to retrace 25%. I'm going to demonstrate this very clearly for you. Right now we're just going over the description of the tactic. Okay, so 25% of the outside bar has been traced. If the outside bar is small, we're going to use the 100% retracement mark. So if you get one small bar below, completely outside the lower Bollinger Band, the lower wide Bollinger Band, then that's a small red bar, then we need 100% of that red bar to be retraced before we go long. Again, I'm going to demonstrate all of this for you in great detail so you thoroughly understand it. Once we are in the long or short, we're going to set a protective stop under or below of the bar that was retraced or above the high of the bar that was retraced. And once in, we simply wait for a takeable profit. All right, this is an income approach, so it's not something you hold for a long time or wait forever to sell. We're looking for a relatively quick snapback toward the middle of the band. Now, I believe in a multiple sell approach. So I teach my traders, we're looking for a snapback to the middle of the band as our first potential target. But that is only going to be a partial sell. Maybe you sell half of your position, because the ultimate goal is the opposite end of the Bollinger Band. So the first target is the midway part. The second target is the opposite end of the band. And so we do a 2-sell step process. If we achieve our first objective in the middle of the band, we'll sell part of the position, maybe even adjust the stop from the original stop to tighten up so that we don't, on a pullback, we don't lose all of our gains. But we're ultimately going for the opposite end of the band. All right? Now, why don't I do this? What I'd like to do is let me demonstrate right before your eyes. I'm going to draw it for you. Let's say this bar is a solid red bar. Okay? It is below the outside of your lower Bollinger Band. This is your lower Bollinger Band. Okay? Lower band. And this bar is fully outside. We are going to, now that we've identified a bar outside of the Bollinger Band, we are going to wait for a subsequent bar to retrace approximately 25% or more of the outside bar. We call this the outside bar because it's outside the band, the outside bar. So we need a 25% retracement, okay? At which point we're going to buy, all right? So this 25%, we buy, a stop goes under the low of the outside bar. All right? And what we're looking to achieve is a move back toward the 20-period moving average, which is the middle of the band. All right? That's our first target area. Now we're looking to risk this for the possibility of this. And even more if we can achieve the opposite end of the band. And you always want a strategy where the risk versus the reward is so imbalanced. You're risking small for the big. So you can have a number of these little losses and have one win and still be in positive territory. All right? Now, the one thing that I have to point out here is that the 25% retracement can actually happen on the same bar. So let's say there's your outside bar, and this bar starts to do this. Let me show it to you. This is very fascinating. This bar starts to do that. And the same bar, I can't make this straight for you, I'm sorry, but the same bar now, maybe if I redraw it and disconnect it, it's better. Well, you get the point. This same bar came off the low, and gave us a 25% retracement. So you can have the next bar achieve the 25% retracement, or the very same bar achieves the 25% retracement. I'm hoping that makes sense. And which in both cases we buy at or near. In both cases, this is our buy. Whether it's achieved on the next bar or the same bar, and the stop is always the same. It's under the outside bar. And the same occurs in reverse. Okay? If this is the upper band, and my outside bar, here's what I want to demonstrate here. Let's say my outside bar is here. Now, but let's say the outside bar is like this. It's not really big. In which case, I don't want to start squinting my eyes. Where's the 25% mark? No, no, no. If the bar is small and it's completely outside, we use the 100% level. Okay? And this becomes either the next bar, let's make this green, either the next bar gives me my 100% retracement, or the same bar does like this. This is very fascinating. I'll show you many examples of this. But look at this outside bar. This would be a bar that we would short here. We'd short this bar right there. Why? Because look at what really occurred here. What really occurred was a bar that went up first, produced some green, but then came all the way back. It lost 100% of its green outside of the Bollinger Band. We take action right there on the same bar. We don't need another bar because the same bar retraced all of the green, 100% of the green. Now, if this green was tall enough, then we could use the 25% retracement. All right? But if the green is not that tall, we use the 100% retracement. And it can happen on the same bar, or it can happen the next bar. So we have two percentage levels to focus on, right? 25% on tall bars, 100% on smaller bars that are outside of the extreme ends of the Bollinger Band. And so let's keep that in mind as we look through our examples here. Now again, I'm going to use the daily chart just for instructional purposes, but this can be applied in every single time frame you trade. Okay? Here. This is an example of what we don't want to fade. You do not want to fade or go against an outside bar that occurs with narrow Bollinger Bands. The bands are rather narrow here. These moves can continue. They pull back a tiny bit and then they explode again to the upside very often. We need the bands to be wide at the point relatively wide at the point that a bar goes outside of the band. Okay? I hope that's clear. So this is not one you want to fade. Now this, on the other hand, is okay. I've got fairly wide distance in my band. I get an entire bar that is outside of the Bollinger Band. I want you to understand that what happened here first was that this bar dropped and was a solid red bar. I'll make it a little wider if I can. This was a solid red bar at the low of the bar. Okay, you see that? And the same bar retraced 25% of itself, which is where we want to go long. Now, it's scary to go long here to a lot of traders. A lot of traders with Oliver, but the stock has been going down. It's a very negative bar. And what if this 25% retracement up is just a temporary phenomena and it goes back down? And I say, well, so what? Look at how close your stop is. You're risking this. So in essence, in reality, it's the safest way to enter. The closer you are to your stop, the smaller your losses are going to be. All right? And so even though emotionally or psychologically it might seem to be risky, it's actually a very low risk strategy. Okay? Now, so this same bar retraced 25% of itself. Now remember, this is the outside bar. It must be outside the Bollinger Band. After entering on the 25% retracement level, the stop goes, a tight stop goes 1 penny under the low. Now, this stock wound up retracing all of its redness to even produce a tiny bit of green. Okay? And our first objective is the middle of the band, but oftentimes, traders, you get the opposite end of the band. You see, there is a statistical average that stocks and financial items can sway before having some form of retracement. Of course, we can always find exceptions to that statistic, but it's about it's 2 to 4 standard deviations away from the norm. And this lower band is 2 standard deviations away from the 20-day average. This gets about 2, 3, 4 standard deviations away. And so that's why I like doing the fade tactic when I'm at that extreme statistic, when I'm near that 3, 4 standard deviations away. And to me, I know I'm there when I get a bar completely outside of wide bands. All right? Now notice, it's not, you can have a stock that rallies near the upper end of the band for a long while. We don't want that. We want to swing from the upper portion to the lower portion, and we want one bar completely outside. This tells me that we're very overdone. Okay? Now, these bands are questionable here, but even if you wanted to take a 25% possibility, if the next bar takes out that 25% level mark, okay, Okay, well, you get the point here. We would go short with a stop above the high. And look, you're only risking this. Even if you're wrong, the loss is just negligible. What we're looking for is this and possibly this. So compare the two sizes. And as long as you're playing this way, math will be your best friend. Statistics will be your best friend. I'm constantly telling traders, do you realize that winning trades happen to everyone? Winning trades are like the sun. The sun shines on the just and the unjust, the good and the bad, the criminal and the saint. The sun is universal. Winning trades are like the sun. Whether you know what you're doing, you will have your share of winning trades. Whether you study or are skilled at trading, you are going to have your wins. You can be skilled at trading, you're going to have your wins. You can be unskilled at trading, you're going to have your wins. You can know everything about financial markets, you'll have your wins. You can know nothing about financial markets, and you will have your wins. Think about the first time you ever traded a market. You had winning trades. In fact, some of you probably had bigger winning trades then than you have now. When you knew nothing. The more you knew, the smaller your winning trades got. That's a common phenomenon. So winning trades statistically happen to everyone because it's like flipping a coin. You're going to get your share of heads, you're going to get your share of tails. What makes the difference then between consistently winning traders is not? It's in the management of the trade and the minimizing of the losing trades. So every trader is going to get winning trades and losing trades. But what you do with your winning trades and what you do with your losing trades makes all the difference in the world. So in fact, a lot of times the selection method is really not as important as managing it. Now, I'm telling you that if you consistently keep your losses to something much smaller than your average possible gain, all right? And this is the, if you keep that ratio, math will take care of itself, and the math, the statistics of doing this will ensure that you stay consistently profitable. It's impossible to not be consistently profitable with this ratio. It's impossible. All right? Because you are going to automatically pick some winning trades and some losing trades. Okay, let's move on here. Here we have a bar entirely outside of the Bollinger Band. But this bar is very interesting because it's a 100% fade bar. It's not the 25% fade bar. All right? Let me draw it for you. Let me demonstrate it for you if I can. All right? Here we go. Check this out. This bar, this red part was not there. If I can draw, if I can get this correct. I can get this correct. This bar was not there. Let's see if I can get it completely whitened out. What was there first was the open and a rally to the upside, but a very small one. You see that? There was a rally to the upside first. So it was first a little green bar outside the extreme ends of the Bollinger Band. Now I told you I like the ones that come from the extreme low to get outside, and the ones that go from the extreme high to get below. All right, but here's this little bit of green. You can't do a 25% retracement on this little green. You have to do a 100% retracement. When all the green outside of the Bollinger Band disappears, I fade in short. Look at the stop is above the high. Then the bar continues to the downside. So my first action was a 100% retracement of green outside of the Bollinger Band. The redness of the bar occurred later. And I hope that's very clear. All right, you were in this bar before the red happened. Now, if we look at the one that happened before, it's, in a sense, it's the same thing. What happened before is, get this to act right here. You had a red bar here. That's where you had a red bar. And then, but it was a little bit of red. It's too small to slice in quarters, in 25% levels. So you need it's the 100% mark here. This is wrong. 100%. Fade 100%. 100% of the red disappears outside of the band. Then, well, no, I'm very, very sorry. This is wrong. I'm going over the wrong thing. I'm very sorry. Made a mistake here. I had it right the first time. This is 25% play. Sorry about that. This bar opens at the upper part of the red, drops, and retraces 25%. So you are coming in on the 25% fade here. Or excuse me for that. Okay? Fortunately, the next day gaps up. But your risk is from this 25% level to that low. And you're risking that in exchange for either getting to the middle or getting to the extreme. The comparison is very, very stark. Okay? Now let's continue with example after example here. I want this drilled in. Notice that you have this entire bar outside of wide bands. Look at the wideness of your bands. Now, this was a green, solid green bar at the high of the bar. Okay? You lose 25% of its greenness. All right? Then it loses all of its greenness. But you're in at the 25% retracement level. That's sizable enough to do 25%. Okay? If you were going to try it on this bar, you need this 25% level to either be retraced on the same bar or the very next day or some subsequent day. We're only doing this on outside bars when the bands are relatively wide. Remember yesterday we talked about being able to identify when you're closer to the top, which we call phase 3 of the cycle, and when you're closer to a 1. Well, if you have if a bar has moved from the bottom of the band to all the way outside of wide bands, you have to assume that you are 1, 2, this is a little cycle, 3, 4, 1, 2, the rest. You have to assume that you're closer to 3 here than you are to 1. All we have is this cycle. Some are more enduring than others. Some are shorter than others. 1, 2, 3, 4. 1, 2, 3, 4. But it's just that cycle repeated over and over again with different durations. So when I'm outside of the band, if it's come from all the way near the bottom of the band, I've got to assume I'm not so far away from 3. And this is where your odds, your good odds, your beneficial odds come from. Now understand that there are some people who will buy this. None of my traders would. They will buy right there after this huge run. But they wouldn't buy here or here, but they'll buy here. And I'm hoping to change you into more of a contrarian trader where you don't buy here after the run from below to above. You buy after the run from above to below. And this is not the easiest place to buy below the low of the Bollinger Band. Because look at what you're experiencing. Wow, you're experiencing extreme negativity. That's extreme negativity. So it's not psychologically the easiest place to buy, but you will over time get used to it by seeing winning move after winning move after winning move, and whenever you don't have a winning move, the loss is negligible or small. So here on this bar completely outside the Bollinger Band, I'm looking for a 25% retracement of the redness or thereabouts. Some traders of mine actually expand that a little bit to a third, by the way. They chop the bar in 3 parts. And they do a little bit more. They want a third. Now, the price of that is that your stops are a little bit wider. I like to use I like to chop the bar into 4 parts and use the bottom 25% level as my let me see if we're starting to get a comeback. All right, 25% fade. All right, stop goes under the low in this case. Okay, and we're looking for, once again, looking for the middle to be achieved, or maybe even the possible high, which by the time it gets there, it's more like this. Okay, still a very good ratio. Okay, now I have circled here some moves that are not completely outside of the bar. The reason why I do this is that some traders will take their chances using the same concept if the bar just pokes through. The preferred or the real approach is when the bar is almost completely outside of the bars of the Bollinger Bands range, but you do get a lot of opportunities where it just pokes through and you still get a move to the opposite end. Just peekaboos through, all right? And you do get a move to the opposite end. So some traders take their chances even though the bar is not outside, totally outside, and it just pokes through. They'll still roll the dice and see if they can get the move. And there's nothing wrong with that, simply because your stops are so close with this strategy that it's almost akin to stepping in a bathtub and checking the water with your toe. And even if the water's not right the first time or the second time or even the third time, and it's right the 4th time, the win on the 4th one will wipe out all the losses of the first 3 and more, because the method guarantees that the stop is so tight using the 25% retracement rule. This trader, the trader who takes them on the end of the range and not outside, would take this 25% retracement here, right off of the low of the band. Here we have an outside bar. But I do want to reiterate this, that you just don't short an outside bar above the high of the band, or you just don't automatically go long, that 25% retracement is very important. All right, you don't gamble and say, well, I'm not even going to do the 25% retracement. This, you could have another bar that shoots even higher. All right, we need that. We need the turn to have begun. All right, we need the turn to have begun. Okay. Here, completely outside of the upper band, 25% retracement or thereabouts. Stop above the high. Risking. Always like to show you this. Risking that for possibility of snapping back to the middle or even getting back to the lower band. But even just a snap back to the middle, the comparison is very big. As long, as I mentioned before, as long as you can keep the ratios between losing trades and winning trades that wide and different, it's powerful. You'll stay in this game a very long time. All right? Here, this is like, so you do realize that based on yesterday's presentation, your buy would be here because you have a fat red bar well below the 20-period moving average, right? That has little to no follow through. So based on yesterday's tactic, you buy above the high. But now including the band, based on today's tactic, combining it, you'd be buying at the 25% retracement level. So you'd be getting in better by combining the band with the red bar takeout strategy. Now, yes, I do have traders that buy at the 25% mark, and if the high of a fat red bar gets achieved, they actually add to the play. You don't have to, but in theory, this one is less risky because if you buy here, your stop is below the low, still okay, but if you buy here, your loss is smaller if it goes south on you or if it goes sour. All right? Again, some traders will try their luck at doing the 25% or 100% retracement, even if they get a poke through and not the entire bar outside. So here's a red bar that pokes through, you get the retracement, all right? And they're just looking for a move to the opposite end of the bands. Right. You can try those. There's nothing wrong with that because your losses are small. But the real play is the band is the bar is almost completely outside. Now, if you look carefully, I'm going to remove this circle for a second. If you look carefully at what happened here, you had some green. You had to start off with some green. This was not there. If I can get this right for you, though. This was not there when this happened. Uh-oh. If I can get it in there again, I'll be able to. Well, that red was not there, guys. All right? That red was not there. When that green was there, the green disappeared and then the red happens. Now, I have traders that watch this very carefully. Wow, we've gapped up outside of wide Bollinger Bands From the open, it's rallied up a little bit. Now all the green's gone short. Stop above the high. And then later the bar a lot of times turns red and drops further. Here at this point, this bar was red. Okay, it was red. Why sometimes it's, I have to do it wider. This bar was red. It lost all of its redness. Okay. So 25% or 100% if you consider that red not enough, 100% of the red is gone. It was outside the band. Now all the red is gone. Snap back to the middle, maybe the upper end. Okay. Look at how, in this example, we drop from the upper end of the band to the lower end of the band at wide extreme Bollinger Band points. I like those. All right. Solid red bar, 25% retracement, which happens the very next bar. Stop below the low, risking this for the possibility of this. All right. Here on the opposite end, you had your 25% retracement. Look at the tail. It was trading at the high of that tail. That tail represents that tail represents 25% or more of the green bar's range. You would probably have gone short on the green bar. All right. Okay. In this case, we actually gap up outside of the band. All right. I don't consider these big green bars, so I would probably be looking for a 100% retracement of that small green bar up there. In which case, this red bar gave me the total 100% retracement of the green bar outside of the band. And the move was very, very rewarding. Now, this happens on 1 minute, 5 minute, 15 minute, hourly charts, daily charts, weekly charts, monthly charts. Time frame doesn't matter. You choose your window. Bar outside of the entire band. Okay? If you didn't capture this bar, certainly this bar was a powerful key, retracing almost all of the bottoming tail bar outside of the Bollinger Band. All you need to do, guys, is have something that helps you determine when the odds are greater than normal that a snapback is going to happen. All right? The odds here of additional downside is different from the odds here of downside. You've already come from here. So I know my odds are higher of a pullback here than they are here. All you need is a tool, anything. I'm giving you one here that gives you the edge in determining when the odds are high that a snapback of some sort is imminent. When a snapback is very likely. Right? But a move from the upper end of the band to correct to the 20-period moving average and to expect now this is not very intelligent. But a move from here to here and be outside this far away from the 20 now tells me I have great odds of a snapback of some sort. I always tell my traders to remember this. Stocks can get far away from the 20-period moving average. They have the ability to get there. They do not have the ability to stay there. Stocks cannot stay separated from their 20-period moving averages for extended periods of time. Look at the separation and then look at how it corrects the separation. Excuse me. Look at the separation and look at how it corrects the separation. Look at the separation on the opposite end and look at how it corrects the separation. It has the ability to get far away from the 20-period moving average. It just doesn't have the ability to stay far away from the 20-period moving average. So all we've done is, with the help of a technical indicator, help us to visually see when we are definitely far away from the 20, due for a snapback toward the mean. The 20-period moving average being the mean, M-E-A-N. All right? Outside of the upper Bollinger Band, distance away from the 20-period moving average. We can get there, we can't stay there. Snapback is imminent. Right? It's simple and elegant. This is a very, very elegant strategy. We go from the lower end of the band to the upper end of the band, and we have a little tiny green bar that is extended outside of wide bands. We need a 100% retracement at this point. The red bar gives us that, where we go short. Our stop is above the high. We are risking this in exchange for this or this. I always like to do this. Look at the difference. This is sexy, elegant, and very highly accurate most of the time. The beauty is that when you aren't right, and there are going to be times, obviously, as you know, when you're not going to be right, but when you're not right, you will lose extraordinarily small, as long as you're using the 25% level. Now, at the time I originally did this presentation, at the time I originally did this, I did this and used examples from that very day. These examples are not from that very day, not from today. They're the old examples from the day I originally did this presentation. But let's look at them anyway. So I was telling my crowd that today, this is what you have in micron technology, the stock. What would you do? They said, okay. Some said, well, you know, I do the 25% retracement, short with a stop above the high. Some people said, well, you know, that's not so much green, so I'm going to wait for the 100%. Okay, fine. At least that was their answer. Outside of the band, we've come from the bottom all the way to the top. If you're wrong using the 25%, your stop is really close. 100%, a little further, but still not that bad. Looking for this possibility at a minimum, and maybe even this possibility. Okay? Just give me just a moment here. Okay, we go from the lower outside of the band to the extreme opposite end of the band, and we get bars outside of the band. Let me move this circle. Here, I'd be looking for 100% retracement of this last little bar. First, I'd be looking for this one. Now, you may have gone short on the 25% retracement of this bar. You may have. Let me talk to you about this. I don't give my traders a choice on stop outs, but you have a choice. On stop outs, we use a 2-bar violation rule. So the stop is really above, if you shorted this bar, your stop is really above the high of this bar. Now, as you can notice, this bar violated your stop. Now, you have a choice. You can utilize my 2-bar stop rule where I need a bar to poke through first the stop. And if that poke through doesn't go too very far, I'll let it sit. And then I use the high of the poke through bar as my real stop. So this becomes my stop reference point for the poke through bar. And if the poke through bar gets violated, that becomes my real stop. However, you can just go strictly, if you poke through your stop, you're out. But every trader needs a re-entry method on stop outs. So if the play, you get stopped out of your first attempt here, if the play is still valid, I am now moving to 100% retracement levels of green because I'm still outside of the band. And if the next bar gives it to me, I'm right back in there. How many times have you gotten blipped out of a trade because of your stop, only to find out eventually exactly what you thought was going to happen happened? A lot, I know. So our traders know, my traders have a rule, and they have no choice in this. You have a choice. Every stopped out trade, they must give one more opportunity to. They can't just stop out and move on to a different trade. They must now look for the next opportunity in the same direction. We call this the second time around rule. The second, I'm sorry about the background noise, guys, the second chance rule, okay? And by instituting the second chance rule, we eliminate 73% of our losing trades. I want you to think about this statistic. By us instituting the second chance rule, we eliminate, or reverse, I should say, 73% of our stopped out trades. So we get the loss back and win. On 73% of our stop outs, we get the loss back on the next chance. It's a very, very powerful act. Very powerful. Okay, I believe we actually looked at this example here. Here's one where, guys, you get these scenarios where the stock can, for a while, ride the upper band. But for me, the best opportunities are when you get a fairly sizable bar. Give me just a moment. They're about to leave here. Okay. What works, what I like to really wait for is when a fairly sizable bar, demonstrates or gets formed outside of the upper band's range. So you have a lot of little bars that ran along the side, but here's where the bar got sizable, and it's actually outside of very wide bands. Now, you have to make a choice whether you go with the 25% retracement here of the green, or you feel there's not enough green and go for the 100%. The difference is not that big. But what you don't want to do is you don't want to start thinking that you can do this from narrow Bollinger Bands. Look at the narrowness of the bands, where it's coming from. Okay? The move from the narrow band to the upper band is just a sign that there's more upside to come. It's when the bands are wide that you are closer to your stage 3 top than your stage 1 bottom. 1. Okay, 1, 2. You're assuming that now you've caught the 3 being outside of the Bollinger Band, and 4 is likely to happen next. All right? Okay? Here's another one. You originated from narrow bands. These moves that go from narrow bands to the upper part are just the beginning on average. As you can see, just the beginning. All right? Here is where it's starting to get interesting to me. There. Now that's not enough green to do 25%, but if I get 100% of that green retraced, right, I'm looking for a fairly sharp reversal. And there you have it, guys. A simple but powerful method to help you determine when the odds are extraordinarily high for a snapback to the upside or a snapback to the mean to the downside. You have to keep in mind that you preferably want an entire bar to be outside of the bands. You want the bands to be wide. You want the move that produced the bands to not come from very narrow bands. So the move that produces the bar outside, go back to the original point of the bands, where the bands really narrow when this move began. That's not what you want. Okay? The preferable ones, actually, if I can go back to a really nice preferable one, the preferable ones come from the bottom and go to the extreme top. Those are the really preferable ones. They go from the bottom to the top and then start reversing. Right? But there you have it, a method that helps you determine when you're at the extremes. Remember, financial items of all types can get far away from the mean, the 20-period moving average. They just can't stay there. The outer bands just give us an additional visual aid of determining when we are really far away from the 20-period moving average. Now, if, as yesterday I mentioned, if you have any questions and you